Hey everybody, just going through and doing our trader trend reviews. This is Nick with 912 Financial Group, and we're going to be going over the trader trend for February issue 2A, so issue 1. It is Saturday, March 4th. It's about 2 weeks after these expired. So we're going to go through and just kind of see how we did. As always, we read through the market expectations and then we talk about how each trade executed or did not, how you could have executed it, because remember, a lot of these are discretionary as well. And we're going to go through and, like usual, keeping up on seeing how we did and reviewing it and moving forward. So, that being said, let's get it going. Um, so, for this issue, we had our market expectation write up. And to read it through, it is still a crapshoot, and we were still in a range. Okay, the range has been expanded from 3,500 to 4,100 to 3,500 to 4,200, thanks to a flood of new buyback announcements that offset poor earnings. The expansion of range has continued to frustrate, only this time targeting folks taking macro bearish or macro neutral positions. Those folks that simply took our advice, going for investor trend suggestions where the suggestion was neutral, the strikes with a short put are far enough out of the money to give you either a great accumulation level or money in your pocket, and the continued grabbing of future investor suggestions for the same reason, get great accumulation levels or it runs to target for minimal cost did great. And if you also add into the mix the trader trend naked put suggestions, you're on average also very happy. But we are still in the range. And though some of the major indexes have moved into macro uptrends, they did so in an unconvincing manner. Yes, we believed the move into an intermediate uptrend a couple weeks ago was also unconvincing, and those that choose to be aggressive were generously rewarded. God bless. But we are still in a range, the top end of the range. And we just aren't in the camp that the market will meaningfully break to the upside, at least enough to justify an aggressive outlook on the macro level. Again, the bear case is we still have very high inflation, earnings are lower, tech is still laying off a lot of people, home prices are still falling, food prices are still rising. Have you seen the price of eggs? And optimism about a narrative change by the FOMC. The bull case, we had that everything was bearish, layoffs, falling housing prices, poor earnings. And it was exactly what the Fed wanted. Bad news assured the Fed that its rate hike cycle was working and they could sit back and let the hikes work through the economy, evidenced by the fact that the last hike was only 25 basis points. But that was derailed Friday because of a very, very strong jobs report and ISM number. As for commodities, the days of King Dollar may be behind us, but that's not going to zero. That said, it's time to revise our commodity outlook to also expect a range. The highs are in, at least for now. As for bonds, we don't see a lot of upside either, but the bottom looks to be in place. Another area where, although they're technically an intermediate uptrend, it just isn't to be trusted. Stay wide with investor trend suggestions there too. That's life in the range, folks. Stay wide, never stops in. So going through these, the featured trade suggestions, remember, trader trend are going to be monthly expirations, right? We're going to be selling, naked units and seeing how we did. And if there is an aggressive entry, we could potentially get triggered into a vertical trade. So that being said, the first in the trader trend here for this issue was Chevron. So CVX, the trade here was recommendation was to sell the February 180 naked call with a stop at 179.45. So if we kind of see on that how we did here, let's go to CVX. So CVX, let me back out to the dailies here. All right, so this is year to date. So going through the dailies, right, you figure you had the stops up at 179 here, and these triggered beginning of February, right? So obviously the price just went straight down with oil stocks getting really weak. So with this one, you would have got in at 40 cents a premium, and you would have got with 40 cents a premium, and with that guy, oop, hold on one second, guys. Sorry about that. Uh, and after that premium, we would have got, let me close this up, make it a little easier to look at. So you would have got 40 cents a premium for that thing, and they went out. Obviously, you would have bid back those units for nickel, and then made $35 per contract. Okay, so moving forward, this one is clearly our uh, investor trend, so we'll cover that quarterly. So going on to HYG, HYG, the trader trend was bullish, um, and the recommendation was to sell the naked put, the February 76th naked put, right when the market opened on Monday, and then if price dropped below 76.07, then you would have entered that 76, 78.50 bull call spread with stops at 75.26 and the target at 78.50. Now again, remember, I'm just going to say it every time. Uh, the verticals here are if you're really, really, really hyper bullish, right? This is just the recommendation that it's a major breakout. We're looking at hard running trending markets. So the results here are always we're gonna leave some up to your discretion. With what you want to do. Now, if you want to follow the write up and just stay wide on this issue, then chances are you probably wouldn't have done any of the verts. You probably just would have sold the short units and that's about it. But by the letter of the law, if you wanted to do all these things, you could have. And the way this one played out, let's go check it out. So we had 76, that's 76.07. So let's look at HYG. And HYG, this was being in February too, right? So we opened up around 76. And initially for the 76 put, you would have got 43 cents. Um, but price opened at 76.06, right? So if you look at it, price opened at 76.06, right at the entry with the stop at 75.26. So you could have taken that bull call spread right on the first day that you got it. But if you did, if you took the 76 naked put, you got 43 cents on that, and then you got stopped out on the 10th for a $62 loss. And obviously you saw that the bonds just went straight down and went all the way down to 73. Well, that was after expiration, but if you kind of played around in here, I could kind of open this up to get those away. So I will. All right, so since the 17th is when they expired. So right, so we got in uh, roughly, you got in roughly right around here, and as its price just went straight down. So on the 10th was when the stop out happened, kind of gap through the stop, and the vertical got triggered too if you had to take it on the first day, and that also got stopped um, for $30 loss there. So if you had to take them both, it was a $90 loss per position. But again, this is just one that potentially you probably would have just sold that naked put and then taken a small $60 loss on that one. So going on to TLT, TLT, it was also bullish hold. The Rico here was to sell the February 107.50 naked put, and if you're hyper bullish, you bought the bull call spread if price went at 107.59 or below with a stop at 105.39. So let's go see how we did on that. So TLT. All right, so TLT opened at TLC opened right at 105.75. So again, it's one of these ones where it opened definitely right above the stop. And we've talked about this many times. Let these things play out. If they open up right above the stop and not under the stop where you wouldn't take it at all, you could let it trade back through here and take the trade if you want to put the vert on, if you're hyper bullish, you're seeing signs of it. Or you just leave it alone. You sell the 107.50, or you don't sell 107.50 because it's so close, or you take a tiny loss if it does. So you got options. This is again very discretionary, but by the letter of the law here, you would have got in and got a $2.27 fill on the 107.50 puts, and you would have got stopped out pretty much immediately for a $3 loss, right? So not a whole lot. And if you had of taken the bull call spread, then you would have taken a $12 loss. So they, really tiny loss if you had taken it at all. Again, when it's that close to the stop, I don't, me personally, I don't take them whatsoever if they're that close. But again, covering it through, going through mechanically to maintain consistency here. So going forward to LQD, LQD, the trader trend was to sell the February 110 naked put and put on a bull call spread if we get to 110.18 or below with a stop at 108.36 and profit target at 115.65. So LQD, So LQD opened at 109.98, right, which you know clearly was underneath the entry here for the bull call spread. So if you had done that, you would have sold the 110 put for 87 cents, and that would have gotten stopped out on February 10th as well, and everything got gapped on February 10th, right over here. Let's see where the gap happened. And so that would have been a $98 loss. And if you had have entered the bull call spread also on February 6th, that would have got stopped out for a $67 loss. All right, so that's bonds. They kind of just went straight down in the beginning of February with rates climbing, clearly. So moving forward to the international ETF and trade suggestions. The first one was EFA. EFA, the trader trend suggestion was to sell the February 69 naked put, and if price went below 69.28, then you would have put on the 69.77 bull call spread with a target of 77.19 to stop at 66.64. So let's see how EFA did. Go into EFA. All right, so EFA opened at 70.72, right? So we were over here, open at 70.72, and you would have sold the 69 put for 30 cents. And that one, the stop was down at 66.24. And so, it did not obviously get stopped out. And you would have gotten collected the premium back. Now, it also never went down to 69.28 to actually get that fill for uh, the actual trade to get an entry here. So that didn't happen, but you got the premium collected at on the 69 puts. Okay, so go into EWW. EWW, the recommendation here was to sell the 54 naked put. And if price dropped below 54.62, then you put on the 54.57 bull call spread with stops at 52.52 on everything, and then a profit target of 56.93. So let's see how EWW did. All right, so EWW, right? There's an entry. Let me blow this up so we can take it down to 17th here. Let's get a bunch of big candlesticks. Uh, so 17th, and entry was, you know, right here on the Monday. So on this one, EWZ opened at 28. 10, I'm sorry, EWW opened at 56.33, and you would have collected a 25-cent premium on those 54 puts, and you would have got that whole thing back for $20. I mean, obviously, price never dropped down to 52, and it also never dropped low enough. It didn't go to below 55.50 to get triggered on that bull call spread as well. So that was just a $20 profit per contract you would have done on the 54 puts on EWW. So there's EWW. Um, the so going on to EWZ, the Brazilian MCSI ETF, trader trend here was neutral. Now again, when these come up, you don't have to do anything, right? If you're conservative, you take cash position, basically just don't enter the trade. But if you're aggressive, you could have sold the February 30 with a stop at 29.70. Let's go see how EWZ played out if you hadn't been aggressive on it. So if you were aggressive on EWZ, you would have sold the 30 call right when the here, let me go back here, right on uh, when this issue came out beginning of February, and you would have got 20 cents because it opened right at 28.10, right? So you got to open right here, and you would have got 20 cents, and if you bid them back for a nickel, you would have got $15 back per contract, and because price never clearly never went up above 29.70 for the stop, just kind of stayed in the same range the whole time. All right, so that's EWZ. Moving forward to the metals, commodities, and so commodity-based ETF trades and main suggestions. We got GLD. So GLD, the trader trend recommendation was to sell the 173 naked put. Um, And if price dropped below 173.23, to put on the 173, 182 bull call spread with a stop at 168.80 and a profit target of 182.12. Okay, so let's see how gold did. So gold. All right, so gold. Let's go back to where it's triggered here. All right, so gold opened at 174.11, and you would have got a $1.35 credit for each of those, which I actually ended up getting stopped out for a $39 loss as price went down during the course of the beginning of February. And the bull call spread would have got filled as well, since price, clearly dropped below the 173. 23, and again, if you were hyper bullish on that, and it did go down and take out the stops at 168.80. And so since it got stopped out right near the oh, I'm sorry, actually it did not get stopped out. My bad. But it definitely expired. These units expired, and so you would have, taken the credit on the short side of it, and got stopped out for the long one. Now, if you had done it, remember the 182s were not sold on 15 cents, so you would have basically, if you had exercised the long calls there, you would have been long 100 shares at 171.65 cost basis, and you'd be holding that, uh, into the next issue, just that stock, waiting to get stopped out potentially at 168.80 or for it to go to profit. So that's where it is right now. If you had to close up the whole position, you would have taken the about $190 loss on gold, or like I said, you could have converted it into stock um, and just been holding stock, waiting for the thing to stop out. If not, with a good cost base of 170, 165. All right, so going on to silver. So silver, the recommendation was to sell the February 21 naked put, and then if price dropped below 21.46, was to put on the February 21, 24 bull call spread with a stop at 20.55 and a target at 24.16. So silver, so silver opened at 2055. It basically opened at the stop, right? So silver opened where the stops were. There's no entry across the board on that whole thing. Just went straight down. So no trade on silver. XME, the recommendation was to sell the February 54.50 naked put. Um, and if price dropped below 54.51, then you entered the 54.50 60 bull call spread with a stop at 52.25 and a profit target of 60.28. So looking at XME, so with XME, price opened over here at 57.55. So you would have collected a 38-cent premium for those 54.50 puts, which you would have got back, right? Price never actually stopped out. It just went down to 54.50, and kind of just sat there, and then went back up and bounced up until the 17th. Now on this one, the you also would have got triggered on the bull call spread, so you got the whole premium back, the 38-cent premium back. If you had a bit of back your nickel, you got $33 per contract. If you had to put on the bull call spread, that would have gotten filled too. Um, and again, this thing didn't hit target, right? But you were up $43 at the expiration. Um, or you could have, again, exercised those long units uh, and and been long 100 shares at a $55.75 cost basis. Just again looking for holding that stock and seeing if price goes to 60. 28 from the cost basis, or if you go down and get stopped out with the same cost basis. So that's where the XME trade did. All right, so going forward, we're looking at the some more commodities here. So we got XOP, trader trend. This one was a neutral trend. So if you were conservative, you stayed in cash, didn't put on any trades. If you were aggressive, you would have sold the 140 call with a stop at 139.73. And on this one, it would have opened. Let's go see XOP. So XOP opened at 134.86. You got $1.90 on the credit there. and it got stopped out on February 10th as things, as things dropped through. I'm sorry, as things, rocketed up through the top through the stop loss here, and you got stopped out for $90 on that one. So you made a little bit of decay, but then you made a dollar of a decay, and then you took 90 cent stop. All right, so going forward to XLE, XLE also a trader trend was neutral. So if you were conservative, you stayed in cash, and if you were aggressive, you would have sold the 87 call with a stop at 86.27. So that's what we did. All right, so XLE opened at opened at 86.04, so you would have collected a $1.85 premium with the stop at 86.27. That trade got stopped out pretty quick from what it looks like here. Yeah, it did. Well, like the same day. So it was very close to its stop, you guys. 86.04, you had what, a 21 cent stop or 23 cent stop. So you would take a $10 loss as that thing just kind of popped right up into the stop. Again, when they're that close, right? We've talked about it, you don't take them. Okay, so going to DBA is next. So DBA, is a trader trend was bullish or hold. The recommendation was to sell the Fed 20 naked put, and if price dropped to 20.08 or below, you put on the 2021 bull call spread with a target at 20.46 and a stop at 19.96. So DBA opened at right, so DBA opened here, right? DBA opened right at 2010. So we got 20 cents of premium for the 20 put, which got stopped out real quick because it was only 14 cents away. So you made a $5 loss on that one. And then if you had triggered the bull call spread on that, you took a $5 loss on that too. It all kind of happened the same day. So it was just hovering right around its stop, and then price, completely ran off with everybody. But again, we talked about before, if you guys wait, right? If you just wait until the wait till you get a little bit of space. If the thing's bumping around, wait till it goes up a little bit and then put the spreads on. Again, if you're hyper bullish, if not, you just could hold that put and and see what happens on it. Or the stops are pretty small on that guy too. But again, give it some breathing room. Let these things play out. It tends to work a lot better than kind of getting killed by a death of a thousand cuts if they chop around too close to the stop losses. All right, so going on to XBI. So XBI, the trader trend here is bullish as well. And on this one, the recommendation was to sell the Feb 86 naked put. And if price dropped to 86.17 or below, the conditional target would have been 91.90 with a stop at 84.26 for the whole position. Let's go say XBI did. XBI. All right, so XBI, go back to when it opened. XBI opened at 89.79. So for the 86 put, you would have got a um, 82 cents of profit on that one, or I'm sorry, 82 cents of premium on that one. And then price actually gapped down through the stop on the 13th. And when that happened, you would have got a stopped out for $141 loss, uh, per contract on that. And then on the 13th as well, that bull call spread got triggered and got stopped subsequently for a $63 loss. So that trend was a trend break, and obviously trended down the entire 2 week period of that uh, of the life of that trade. So two stops on XBI. And going forward to the real estate ETFs, we're looking at VNQ, and VNQ, the recommendation here was also a bullish or hold here. So you would have sold the February 89 naked put, and if price dropped to 89.44 or below, you would have put on the 89.95 bull call spread with a stop at 87.39 or a target at 95.57. So let's see how VNQ did. All right, so VNQ, back to the beginning of February. So VNQ price opened at 90.80, and you took an 81 cent premium in for those 89 puts. which actually never got stopped out. Right, price stayed above stop the entire time. Right, it was the last day here, so those went out for a nickel, and you would have taken 76 cents a premium in per contract. Now, if you had of taken that bull call spread, right, the bull call spread was still live as of the 17th here, so you would have been long 100 units if you had have exercised the options, or you could have taken a $58 loss on the whole spread at expiration, or you could have been long 100 shares at 89.75. Still been waiting for the stop out, which it clearly would happen over the next few days, but that was how that one worked. So you made the premium on the short put. The spread got stopped out. Either if you had stopped yourself out at expiration, or if you had taken the stock and then just waited for um, the actual waited for the stop loss to get hit. All right, so going forward to XHB. XHB, the trader term recommendation was to sell the 65 naked put, and if price dropped to 65.20 or below, was to put on the 65.71 bull call spread with stops at 62.99 and a take profit at 71.85. And so let's see how XHB did. Going back, so XHB opened at 70.45, so you would have taken a 21-cent premium in for the 65 puts. Those you got them back, right? Price didn't go down to 62 from way up there, and you would have collected the 16 cents per options contract. There was no entry on the bull call spread as well. So going forward, all right. So going into SPY, the trader trend was bullish as well. Recommendation was to sell the 402 naked put. And if price drops to 402.48 and below, you put on the 402, 426 bull call spread with a stop at 394.49 and a profit target of 426.48. So looking at SPY, SPY opened at 409.79. So for those 402s, you took in 274, which you got back, right? Because price never dropped down below 394 up until the 17th year at expiration. So just kind of stay in that sideways range for that entire 2 weeks. So you would have taken in a $269 premium per contract there. And the bull call spread never got a fill either. All right. So going to the Qs. Q's trader trend was also bullish. The recommendation was to sell the 291 naked put, and if price dropped 291.42 or below, then you would have put on the 291.308 bull call spread with stops at 285.57 and a target of 308.68. So the Q's going back. So going back, the Q's opened at 303.51, so you would have taken a $2.02 net credit on those 291 puts, which again, price never got stopped out. And you would have taken, bid them back for a nickel and made $197 per contract on the Qs. The bull call spread also did not get filled on that trade, just a sideways market, and that's it for the Qs. So going to IWM, last but not least, uh, the trader trend was also bullish to hold. The recommendation was to sell the 187 naked put, and if price dropped to 187.20 or below, you would have put on this 187 200 bull call spread with a 182.93 stop and a 202-cent target. Price opened at IWM. So price opened at 195.65, right up here. And so price opened at 195.65. You would have got 81 cents a premium. Price never got stopped on that one either. And you would have taken in $76 per contract on that too. So that's all of them, you guys. Now, going through, we like to kind of add them up. Let's say, as a standard kind of benchmark, we're just saying that we're doing one contract on everything, right? Regardless of size, everything gets one contract. And so if you weight it that way, adding them all up, if you had just done the short units, kind of stayed wide on the trader trend, not put on any of the spreads, you'd be up $350 on this uh, per single contract on the whole thing. Now, if you had done the verticals, you would have lost 382. So it would have made kind of the entire 2 weeks a wash there. And that's kind of why, I'd like to say just kind of follow the write up on what the recommendation is. But again, over time, as you see doing these reviews, there's some months that are winners, some are losers, some go flat like this one did. But over the trend, they're green and profitable, and they've been so for a long time. So hopefully, again, you guys, this really helps for execution and to know how to kind of manage these things. It's really not that complicated or difficult once you kind of start putting them in a few times. It just takes a little bit of work to do the management, but it is a professional level trading and professional level risk management. And we'll see you next time. Thanks for tuning in. Please like, subscribe, tell your friends. Let's help this spread the community and get 912 growing. All right. Thanks, everybody. Bye.